Most people who start a business never actually build one. They build themselves a job, a demanding, all-consuming job that happens to have their name above the door. And the day they finally try to step away, they find out the hard truth. It was worth almost nothing. There is a single test that decides which one you have built, a real business or an expensive job. And most owners fail it without ever knowing the test exists. This is step one of the blueprint, and everything else on the plan rests on getting it right. Quick, but it matters. This is general information, not personal advice. Your situation is your own, so get advice before you act. Now, why does the whole plan begin here? Because every step that comes later runs on one thing: capital. The property in step 2, the shares in step 3, the exit in step 4, all of it needs money to feed it. And for most Australians who build serious wealth, that money comes from a single source: a business that throws off far more than it consumes. The business is the engine. Everything after it is just deciding where the engine's output goes. Get the engine wrong, and there is simply nothing to build the rest of the plan with. So let us start with why it is the engine, and not just the first item on a list. Of every asset on this plan, the business is the only one you can actively make more valuable with your own decisions from the inside. Property you mostly buy and then you wait. Shares you mostly buy and then you wait. A business you build. That makes it the highest control, highest return asset most people will ever touch. It is also the only real source of surplus, and that word matters. A wage from a job feeds a household. The surplus from a genuine business feeds a plan. That surplus is what puts down the first property deposit, services the debt behind it, and years later funds the share portfolio. None of the later steps generate their own fuel. They spend what the engine makes, which is exactly why the order is not arbitrary and why it cannot be reordered. You do not start with property and backfill a business later. The engine comes first because until it is running, there is nothing to power. And there is one more reason it sits first. A well-run business can often reinvest its own profit at a higher return than that money would earn sitting anywhere else. So in the early years, the smartest place for the surplus is frequently back into the engine itself. It does not just produce fuel for the later steps. It compounds inside itself, quietly growing the very asset that will one day be sold. That is a lever the other 3 steps simply do not have. Now, the test. Here is the distinction that decides everything. Picture 2 businesses, same industry, same profit, the same number on the bottom line. One of them is worth a fortune, the other is worth almost nothing, and the difference is not how much they earn. It comes down to one question: does the business need you? Could it run for a few weeks without you in it? A few months? If the honest answer is no, then you do not own a business. You own a job with staff and overheads attached. And a job cannot be sold because the moment you walk out the door, the value walks out with you. Think about it from the buyer's side. A buyer is not paying for your effort. They can hire effort anywhere. They are paying for a machine that produces a result whether or not the founder turns up on Monday. So when a buyer looks at a business, the first thing they are quietly measuring is how much of it is really just you. How much of the revenue depends on your relationships? How many decisions still route through your head? The more the answer is all of it, the closer the price falls toward nothing. That is the wall most businesses quietly hit. And name it plainly, most businesses never become saleable assets. Not because the owner did not work hard enough, usually the opposite. They worked incredibly hard, but in the wrong place. They became the engine instead of building one. So what actually separates the business you can sell from the job you cannot escape? It is not working harder. It is running the thing like an asset from the very first day. And this is the part generic business advice skips because none of it is glamorous. Start with the books. And I do not mean tax return books done once a year to keep the accountant happy. I mean books that tell the truth every single month that the owner actually reads and makes real decisions from. A business that cannot show a buyer clean, believable numbers is not sellable, no matter how much it quietly earns. Then, the money the business collects but does not own, the GST it charges, the PAYG it withholds, the super it owes. A disciplined operator quarantines that money the day it lands and never once treats it as cash flow. More profitable businesses have been sunk by spending the tax office's money than by any downturn, and that failure has its own breakdown coming. And it is not about tracking 100 numbers. A CFO watches only a handful that actually move the business. What each dollar of sales keeps as profit, how much of that profit turns into real cash in the bank, and how long the business could keep running if the money stopped coming in tomorrow. Because profit on paper and cash in the account are not the same thing. And the gap between the two is exactly where a lot of profitable looking businesses quietly get into trouble. Knowing those few numbers, cold, is what running on real numbers actually means. And then the knowledge. In a job, the important knowledge lives in one place, the founder's head. In an asset, it lives in the business. Written down, documented, teachable. The systems are the business. Because again, a buyer is not buying what you know. They are buying what the company still knows on the morning you are no longer there. None of this is exciting. All of it is what turns a job into a machine. And there is one more piece. The one almost nobody thinks about at the beginning, that quietly decides how much of it you keep at the end. The structure. How the business is owned and set up on day one decides what is possible on the day you sell. Australia has a set of concessions written specifically for owners selling an active business, concessions that, used correctly, can dramatically reduce the tax on that sale. But they are not automatic. Whether you can reach them cleanly is very often decided years earlier by how the business was structured and by what it holds. The right setup does more than protect the exit. It lets profit flow into the next steps of the plan without being taxed at the very top rate on the way through. And it protects the asset while you spend years building it up. The valuable parts of a business, the intellectual property, the build-up goodwill, the profit you have accumulated, sit in a very different place from the risky day-to-day trading. Keeping those parts deliberately separated from day one is what stops one bad year or one bad claim from reaching everything you have built. It is quiet, unglamorous protection. And like the concessions, it is far easier to design in at the start than to bolt on at the end. Get the structure right early and the exit is quietly waiting for you when you arrive. Get it wrong, and you can spend the entire journey slowly unwinding a decision you made in a hurry in week one, which is the real lesson of step one and the thread that runs through this whole series. The exit is not built at the end, it is built at the beginning. So step one is not simply start a business. It is this: build the engine, an asset that runs without you. That reads its own numbers and quarantines what it owes. That keeps its knowledge in the business and not just in your head, and that is structured from the very first day to one day be sold. Because everything else on the blueprint, the property, the shares, the exit, is only ever what you do with what the engine produces. No engine, no plan. But get this one wall right, and the other three finally become possible. That is why it starts with a business. Next in the series is step two. What people actually do with the profit once the engine is running, and why the order, business first, then property, matters more than the property itself. If this was useful, hit the like button. It genuinely helps the channel reach more Australians who need to see this. And subscribe so you catch step two the moment it lands.